People's deposits in a bank create a big cash pool with the bank. As per the directives of the Reserve Bank of India, banks hold about 15% of their deposits as cash to arrange for daily withdrawals by depositors. Did you know the percentage of cash reserves against deposits that a bank must maintain at all times is called the cash reserve ratio, or CRR. This ratio keeps changing from time to time depending on the prevailing economic conditions. A major portion of the remaining deposits is used by banks to give loans to people for different requirements. Why do banks give loans? The depositors of a bank are allowed to withdraw their deposits on demand and are paid interest on these deposits. On the other hand, the borrowers who take loans repay it to the bank along with interest thereon. The interest charged on loans is more than the interest paid by the banks on deposits. The difference between the interest charged on loans and the interest paid on deposits is the bank's income or profit. The loan given by a bank is also referred to as credit. A loan or credit is subject to certain conditions that the borrower must agree to. These conditions are called terms of credit. The borrower has to pay interest to the lender at a specified rate on the amount taken on credit. A lender often asks for a security against a loan to recover the money in case the borrower fails to repay it. This security is called collateral. The assets that are commonly accepted as collateral against loans are land or property, vehicles, livestock, standing crops, and bank deposits. The lender reserves the right to sell the collateral in case of non-repayment to recover the loan amount. A borrower often needs to submit certain documents like proofs of identity, residence, employment, and income as specified by the lender to avail a loan. A loan is usually given for a specific duration of time and needs to be completely repaid by a specified date. The borrower repays the loan in cash, by check, or by card in installments, or as a one-time repayment as specified in the mode of repayment. Many people need extra money for different reasons. But does credit benefit everyone who takes a loan? Consider these two people. They both want to take a loan to start a small business. The man who started the dairy took advantage of the rising demand for milk and made a good profit. He repaid his loan in time. The man who started the poultry farm suffered a big loss in business due to the spread of bird flu and is struggling to repay his loan. Thus, credit can bring about a positive or a negative change in a person's life.